traders and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump is set to unveil his reciprocal tariff push during an event at the White House Rose Garden tomorrow on what he's called Liberation Day. Now, the announcement is expected to feature so-called country-based tariffs with, we're told, no exemptions. But he's promised to be kind.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
Now we're joined by Hugh Gimber, global market strategist at JP Morgan Asset Management. Also with us, Russell Matheson, Bloomberg's EMEA News Director, and Brendan Murray, who leads our global trade coverage to figure out exactly what we'll be faced with tomorrow. So, Brendan, I mean, look, we know that Donald Trump is announcing these reciprocal tariffs, but actually the extent of his levies remains unclear.
Yeah, exactly. So it sounds very generous, the president saying he's going to show leniency, but reciprocal is just a euphemism for higher. America's biggest trading partners are going to see higher tariffs imposed on their goods imported into the U.S. Donald Trump has been complaining about the U.S.'s unfair trade relationships dating back to the 1980s, and that culminates tomorrow in a Rose Garden ceremony where he's going to settle some of those scores.
I mean, when he says he's promising to be kind, Roz, what exactly does he mean?
Well, that is the question. I mean, even if he announces tariffs that are not, it's not a blanket percent, but it's actually like depending on your country or whatever. I mean, as Brendan was saying, it's still increasing tariffs, and in some cases, potentially stacking tariffs upon tariffs upon tariffs. So these add on to other tariffs that are already in place or announced recently. And so you're getting a very complex soup here in terms of tariffs on certain goods, and that's a lot for countries to absorb and deal with and work out how to navigate. I mean, obviously he's got competing demands in himself in a way in all of this. He wants to show he's raising money, even though this is really more sort of an issue for US consumers who are paying more versus revenue raising. He needs to show some room to negotiate because he always wants to negotiate going forward. So this is a starting point perhaps for changes, but also he needs to show that he's being tough. So he's got all those competing demands. So where kind fits into that is a bit hard to know.
Yeah, and for market participants, I know there's a lot of noise and you have to, move away from that. But actually, what does the president want to achieve at the end of the day, Hugh? And will it be inflationary?
And that's the critical question about the objectives that are being targeted. If you go back to February when the first announcements were made on Canada and Mexico, this was about immigration, this was about drugs crossing the US border. In other words, it was about foreign policy goals. And therefore, quite quickly, we could get to the point where a deal could be struck, tariffs walked back, and markets were quite happy at the time to dismiss tariff headlines as a negotiating position and really bluster. What's changed in the past couple of months is the objectives that are being cited. So as Ros mentioned now, you have a broader goal to reshore manufacturing. You have the consideration around raising revenues, potentially in order to fund tax cuts later this year. And I think the most challenging thing for investors is that some of those goals are contradictory, right? You can't reshore manufacturing and raise lots of revenues, and therefore it's unclear how much of what we're going to hear tomorrow is a first negotiating stance or actually a tariff that's going to persist well into the latter part of this year, because your macro impact differs a lot.
But so, Hugh, what do you think the North Star is? I know, there's a lot of talk again about the Mar-a-Lago Accord, which we talked about yesterday on TV. At the end of the day, does President Trump look at a lower dollar, or does he want a lower dollar, or what will be his, measure of success?
So a lower dollar and lower 10-year bond yields seem to be the two key areas of focus for this administration. Now, obviously, the extent to which you can do that without challenging the long-term growth prospects of the economy is a bit of a conundrum. But from my perspective, I think two things are clear about the US. This, A, clearly weighs on growth, and we're seeing that already in the capex intention surveys in particular, and B, it puts upward pressure on inflation. Now, the extent to which those two move is obviously the key challenge, but this is where you take Friday's labour market report, it becomes really significant, because for the Fed, at the moment, they don't know the the difference between this growth and inflation shock, and it's likely the labour market data that would move them off the sidelines.
And then, Brendan, you have industries basically trying to carve out, their special kind of moratorium. U.S. car makers seeking concession for auto tariffs.
Yeah, exactly. So the auto tariffs for fully made cars kick in on Thursday, but for parts, there's another month of a lag for those to kick in. So the automakers are looking at both of those and saying we can absorb some of it, but all of it we can't absorb. They import components from all over the world, basically South Asia, North Africa, and so they're trying to make the case to the president that, look, if you don't give us an exclusion on some of this, then there are going to be job losses, there are going to be profit reductions, and really it's going to work counter to what you're aiming to do.
Yeah, and Ross, I mean, this is not an economic tool only, right? This is also a political tool. So could there be U-turns? Is there anything that leaders are now trying to do to soften the blow, or are they holding strong?
Well, you see a lot of leaders wanting to have direct conversations with the US, thinking maybe if they can just get in the room with Donald Trump or some of his senior officials, you get the right official, you get the right ear, and maybe you get some special treatment for yourself, be it Australia, the UK, the EU, or countries in Asia. But you also see the tough messaging coming, which is the EU even this morning saying, we're ready. If you come for us with reciprocal tariffs, we will come for you. I mean, the interesting thing is they're not necessarily retaliating straight away. They are giving themselves a bit more space, which seems to be a slightly different tactic, perhaps adopting the Mexico model of just sitting a bit quietly and letting Trump stew a bit before they respond. But so that seems to be one way that they're acting. But obviously, they're all trying to carve stuff out for themselves alongside key companies. I mean, Brendan just mentioned the auto sector. So you have a staggered approach. They have built that latency in where you get, first of all, it's entire cars, and then it will be parts. And so, again, Trump always leaving room to negotiate and to change his mind because, again, that's how he operates, be it whether he's looking at these things through a foreign policy lens and using tariffs as a political tool there or as an economic and market one.
Yeah, I mean, the other concern, and this took a lot of people by surprise, is that, there's a lot of U.S. chip giants now that are in limbo because of what we heard from Howard Lutnick pushing for bigger investments back home. Again, what does it mean for the industry, or in general, is there a question about U.S. exceptionalism that markets have to grapple with now, not wait 6-8 months?
It's absolutely a question for now. And you think where we started from at the beginning of this year, a very broad, crude consensus was that the U.S. administration was going to be brilliant for the U.S. economy and terrible for everywhere else, quite simply put. And so what we're seeing so far this year is question marks on both sides of that. You're seeing the exceptionalism of the U.S. growth story clearly called into question at the same time as you're seeing actually a much stronger than expected policy response coming from other regions. And so when you look at how markets are moving, if the next leg of this is to start to put more pressure on the tech sector, that should be another factor that supports this rotation into international markets.
Yeah, but will it also play off, I guess, countries against each other? Is that part of, if you do a lot of uncertainty and make sure that leaders are kind of competing to grab your attention, then it makes it where everyone's worse off?
Well, that's what he's also very good at doing. We can see that even in Europe. So you've got Emmanuel Macron, the French leader, trying to build on his personal relationship with Donald Trump. We obviously saw that the leader of Finland really hit it off with Trump recently because they play golf together and managed to get a deal for icebreakers out of it for Finland. So they are all negotiating their own corner. The challenge for Brussels when it comes to the EU is to get that kind of European unity to hold everybody to hold the line because each country in Europe is impacted differently by tariffs. So it's not as though one's better off, they're not all worse off or better off at the same. So they have a vested interest. If you're, obviously car makers in Germany, that's a real concern. And so you can see each leader is going to be trying to get the most advantageous thing for themselves, even if in theory they're negotiating as a bloc.
Yeah, and Brendan, I mean, it's quite a show. So we're expecting some, big announcement. I'm sure a lot of leaders and certain market participants will be tuning in. It feels like, a TV show.
Yeah, it's the Rose Garden, right? It's where, you host astronauts who've come back from space, or you sign a peace treaty. It's a big ceremonial place symbolically. I'd be interested to see, we talk a lot about Canada, Mexico, and Europe. I'm curious to see how China is treated tomorrow. President Trump wants to do a deal with Xi Jinping, and how much pressure is he willing to put on Beijing to drive them to the negotiating table? Will we see another 10% tariff put on top of the 20% that's already there? That'll be one of the interesting things to watch tomorrow.
Because we haven't heard that much. I mean, it does feel like we've again, it's hot and cold actually, the relationship with China.
Yeah, as far as we know, the two leaders haven't spoken in any way that would in any substantive way since Trump took office. So. As Roz mentioned, Trump likes to put pressure on, put leverage on, to drive the other party to the negotiating table. So perhaps we'll see more of that tomorrow.
All right, thank you all for joining us. Of course, Rosalind Matheson, Brendan Murray, and Hugh Gimber from JP Morgan Asset Management stays with us. We'll talk a little bit about value in Europe as well. Coming up, the French far-right leader Marine Le Pen speaks out after being convicted of embezzlement, saying she's been silenced. We'll discuss the implications next, and this is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now we're back with Hugh Gimber, Global Market Strategist at JP Morgan Asset Management. Hugh, thank you so much for sticking around. We were talking and we were having a great conversation about some of the known unknowns that could hit tomorrow with Liberation Day, as Donald Trump called it. How do you build a portfolio around all of this uncertainty?
So diversification is the obvious answer, and that sounds like a lazy response. Everyone's going to talk about diversification being your friend. But I think the key difference in 2025 is that we're following 2 years where diversification absolutely did not work. You did not want to diversify. You did not want to consider valuations. You wanted to own US tech, regardless of all else. And so the difference about this year is that we're seeing diversification working really well again. So compare, for example, moves in European bonds and equities and US bonds and equities. In the US, you have the growth hit hurting stocks but helping treasuries, and you have the opposite playing out in Europe. And the same is true at a sector level. So that broad diversification is key. More specifically, when people talk about uncertainty, there's always uncertainty again. But the difference this year is that you're looking at an uncertain environment from both a growth and inflation perspective. So bonds are an excellent diversifier in our view against recession risk, but you also need to consider more the real asset side of the portfolio that can offer some protection if it's more of an inflation shock than a growth shock that we're ultimately facing.
Do you assume that every meeting from the Fed is now live?
I wouldn't go that far, because I don't think at the moment the labour market data has given them a clear enough steer. Conversely, for someone like the ECB, where the tariff implications are a much clearer growth shock than they are creating in any inflation pressure, we see the ECB on a much smoother path back down to 2%, and then potentially further if it turns out that growth is really hit as a result of tariffs.
Hugh, when you look at equities, I mean, do you look like industry by industry? Again, we had the chip news this morning, which is putting a question mark on big tech in the US, or do you really look at regions, so Europe looking maybe a bit more attractive than the US on a simple valuation basis?
The two are one and the same. I think if you want to believe in that the European rotation has legs, you also have to be willing to accept that the tech story is now starting to fade. And that's exactly what we're seeing. It's no surprise to me that while we've seen this big rotation out of the US into Europe so far this year, you've also had tech and communication services as two key underperforming sectors globally. So So in my mind, the two are quite nicely aligned. We came into this year expecting to see a broadening of earnings growth across a wider range of sectors. That's exactly playing out so far. And you now have the policy catalyst coming through from greater fiscal stimulus in Europe, coupled with more supportive policy from the ECB. So you think about Europe really having suffered from monetary, fiscal and regulatory policy over the past couple of years. All of those things now seem to be working much more in Europe's favour. But
Europe's away from automakers, I imagine, away from, I mean, is retail the place to be? Luxury also took a big beating because of China. I'm not sure what industry group has actually something really going for it.
I mean, take the banks as one example. Clearly, they've moved a long way in the past 12 to 18 months, but I think often when you look at financials, people will take valuations relative, say, a 10 or a 15-year average. Yeah. And in that scenario, you're comparing the European banking sector to one of its most challenging periods on record. So just looking at a simple valuation today and saying, well, how do I stack up relative to 2014, it is clearly not fair. Similarly, in industrials, healthcare, we find many examples of excellent global companies that are still trading on a larger discount to their US peers simply because of where they're listed. So we finally now seem to have investors around the world waking up to the fact that Europe actually has some very good companies indeed.
Hugh, thank you so much. Hugh Gimber there from JP Morgan Asset Management. Now on to politics, and the French far-right leader Marine Le Pen has lashed out at the decision to bar her from running for elected office for 5 years. Now, Le Pen and her National Rally Party were found guilty of embezzling more than 4 million euros of EU public funds to finance party operations in France. She's told the French television that the decision effectively eliminates her from the 2027 presidential race.
I think the judges got it wrong. I think they chose to ignore all of the explanations that were given because in the very first hours of this trial, I had understood that the court was biased against us. I did not think that the magistrates would go this far against our democratic process and interfere this much with the choice of the French. Let's be clear, I have been silenced, but it's the voice of millions of French people that have been silenced as we speak tonight.
Let's get the latest now with Bloomberg's Caroline Conan in Paris. So, Caro, does this decision actually embolden the far right?
It is very possible, Francine, because Marine Le Pen, as you heard on this TF1 interview last night, appeared very defiant, saying that she's going to continue the fight, not even believing that she won't be able to be a candidate in 2027. She still believes she can appeal. She still has a very thin hope that the appeal would be pronounced before the presidential elections in April 2027, perhaps at the end of 2026. And when she was asked about whether Jordan Bardella would be a plan B, she clearly said that he is a great asset for the party, for the National Rally, but it is too early to use him, as if she considered she could still be the candidate in 2027. So now you could think this is denial, or this is kind of a Trump strategy. Before Trump was elected in his second term, remember, he had a lot of criminal cases against him, and he used that to kind of galvanize his troops and say that the judges and the whole system was against him. We'll see what also that could mean for the parliament. Remember, Marine Le Pen remains an MP. She's just banned from running for office in the next election, but she's still in the National Assembly. Remember also the parliament is fragmented, and in December she played a very key role in making the former Prime Minister Michel Barnier's government collapse. So what comes next? We actually talked to one analyst from Teneo who said something very interesting, is that if the National Rally is framing this as a liberal conspiracy, perhaps it could actually double down with a motion of no confidence against the Macron's government. No one in the National Rally has talked about this quite yet, because I think the tone at the moment is really to talk about some kind of plot against the National Rally, but clearly this could destabilize French politics over the next few months.
Caroline, thank you so much. Caroline Cornell there in Paris. Now we're joined by Marta, Lorimer, a politics lecturer at Cardiff University with the focus on European politics. Thank you, Professor, for joining us. So when you look at, the pretty incredible day that we had yesterday, will this make Marine Le Pen and her party even more popular like we've seen in other countries?
Well, it's unlikely to make her more popular, but it is also not going to lose her many votes. And this is, I think, the main expectation that we have is that the National Rally is going to stay pretty much where it is. Most of its voters won't really care about the fact that Marine Le Pen was declared guilty in this case, because at best they will think that it is okay to steal money from the European Union, and at worst they will believe that there is some kind of liberal conspiracy. I think it does make it a little bit more challenging for her to actually appeal to to a larger electorate, because if she goes with the victimhood card, then that might work. But part of the victimhood card requires her to be heavily anti-system. And that is something that in the past has kept the National Rally from actually getting into power.
Does it mean, if you look forward for the presidential 2027, a lot will depend, of course, on what kind of leader the RN chooses that's maybe palatable for the election. But what does it mean for the presidential race?
We're still very far away from the presidential race. I think one of the underappreciated thing of French politics is that talking about the presidential 2 years before doesn't really make much sense, because we don't know who is going to be running. And voters will make up their mind a little bit closer to the date. And this is particularly true this time around, because Marine Le Pen keeps saying that she is going to be in the running. That seems to be the party line that they are going with. Everyone is repeating it within the party. But whether that actually holds is an entirely different question. I think there are going to be people within the National Rally that say, well, listen, maybe we should start thinking about a plan B. And that could generate some tension. And then if the appeal doesn't arrive on time, then they're going to be scrambling to find a candidate 6 months before an election. It could work well for them. Emmanuel Macron appeared on the scene very close to the 2017 presidential election. But the National Rally, unlike Macron, is a party with a very long history. So they're more of a known quantity. And whoever they select as their leader will also be a bit more of a known quantity.
I mean, there had to be a big shuffle in legislative elections because of pressure for Marine Le Pen. Does this make life easier for Emmanuel Macron? Will we see fresh elections soon, or does it buy him time?
This is another one where, unfortunately, we don't really know, because it could go both ways. On the one hand, it's in the National Rally's interest not to have an early election, because if they have an early election, then Marine Le Pen cannot run in it. And they have already been sort of countering this narrative yesterday when they started saying, oh, people think that this is going to make us less likely to vote a no confidence motion, but we are just as likely to do so. If it comes to a point where we have to do it, we are going to do it. This doesn't give us any certainty, of course, whether they are going to do it. But I think what might push them to try and avoid an early election is precisely the fact that they are genuinely in denial. They still think that Marine Le Pen will be able to run, and they haven't yet pivoted to the alternative strategy of saying, well, let's get Bardella to run as president, and then Marine Le Pen can run as prime minister.
Yeah, I mean, my understanding is that, all of this could still be suspended if there's an emergency appeal before the Constitutional Council that basically decides that voters' rights should prevail over the letter of the law.
It's still debated whether that is something that she can actually do. There's some discussion about whether this calling upon the Constitutional Council to actually give a ruling on this is something that is feasible. If it is feasible, then yes, they might be able to return a judgment. But once again, we don't know if it would go in Le Pen's direction. The Constitutional Council has already ruled in the past on this very law and has declared it constitutional. They might object to the fact that, that there's been a declaration that she couldn't run. But again, there's absolutely no guarantee that this would go in her favor.
Professor, thank you so much. Marta, Lorimer, politics lecturer at Cardiff University. Coming up, the UK braces for Donald Trump's big tariff announcement tomorrow. We speak to Lloyd Dorfman. This is Bloomberg. Good morning and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Traders brace for more volatility on the eve of Donald Trump's Liberation Day, when the U.S. president is set to unveil his so-called reciprocal tariffs in the White House Rose Garden. France's Marine Le Pen says the rule of law has been violated after she was banned from running for office following her conviction for embezzlement. Plus, funding from the U.S. CHIPS Act is in limbo as Commerce Secretary Howard Lutnick seeks to renegotiate the terms. So the UK is expecting to be impacted by U.S. tariffs this week, despite ongoing talks to secure an exemption for British goods. It would be a blow for the Labour government, which has been trying to convince Washington that the trade relationship is balanced. Well, let's discuss all of this, how these trade tensions will affect the UK economy, with Lloyd Dorfman, founder of the Travelex Group, the world's largest retailer of foreign exchange, which he started in 1976 from one small shop in central London. So, Mr. Dorfman, thank you so much for joining us. I mean, there's a lot that we need to talk about because you're also involved in the arts, media and communication. But let's start with 2025 in the UK.
Okay.
When you look at all of these trade pressures, living cost issues and everything in between with what the Labour government has been trying to put in place, how difficult would it be today, 2025, to be an entrepreneur in the UK?
Well, I think the government have repeatedly said that they're very keen to promote growth, and promoting entrepreneurialism is absolutely the way to do it. I don't think it's difficult to start a business today. I think I'd like to see a bit more help from the financial community, particularly the banks. I'm not convinced that talking to regulators is the quickest way to promote growth. And, at the end of the day, to solve our economic problems, we've got to grow the cake. You can't keep cutting up the same size cake into smaller pieces.
But how do you grow? Because there's a laid-out plan from the Labour government, but we've also seen a lot of pressure from investors, which make it much more difficult, because this is a small, open economy that relies on the generosity of strangers when it comes to gilt buying.
Well, yeah, look, I think at least the one thing we have now is some sort of political stability, whereas, up until July, things were a bit of a roller coaster. So I think from that point of view, things have improved. But I think the government have, they've got to stop just talking the talk. They've got to walk the walk in terms of promoting growth. The budget, national insurance, that is only going to result in job cuts and price rises, which is just not helpful. So I'm not seeing anything that is actually stimulating growth. They've got to go and do that. I think as an entrepreneur, I think it's never been easier to start a business. You can do it from your bedroom today. But I think in terms of financial support, mentoring, the banks, I think just that they need to be a little bit more supportive than I'm sensing they are.
Do you feel that a lot of people are leaving the UK?
I do. And this is a big worry. Anecdotally, I think I heard some statistic, I think something like 10,000 millionaires have left. That's a real problem. When I started work in the 1970s, we had something called the brain drain. Tax rates were, in some cases, 90% plus. And people were leaving because there was no incentive to work here in the UK. And I think at a time when they're trying to promote growth, to drive away the people who could be the engines of that is just counterproductive. And I think at a time, for centuries we've been a great mercantile nation. I sort of sense at the moment we're pulling up the drawbridge and somehow somebody's whispering in the Prime Minister's ear to say, well, let them leave, it won't be a problem. It'll be a problem.
It'll be a problem because, what, of capital raising? This is millionaires that are mainly non-doms.
Yeah, but I think, but it's not just non-doms who are leaving. You know, there are people who are selling businesses, running successful businesses who, you know, just don't see a future here. And I think that it's not just about the non-doms, but I think we have to be competitive. You know, people are paying 200,000 euros to go and move to Italy. I hear you can't buy a property in Milan because so many people are going to do that. Well, was it really difficult for us to come up with an equivalent, to update our own non-dom scheme? And you know, these are people who are, you know, creating economic activity, leading businesses, but it's not just about non-doms. You know, I'm aware of people who are selling up and going.
Yeah, I know you're very involved as chair of the Royal Opera House in the arts and also education. Do you worry about the arts, that there's not enough going on, actually? There's not enough support from the government because of lack of money?
Yes, yes, and yes. I mean, the Opera House, you know, which I have the privilege to chair, is, you know, the largest employer of creatives in this country after the BBC. One of the preeminent performing arts organisations, not just in this country but in the world. I mean, the whole sector is sort of on the ropes at the moment. I mean, the Arts Council budget is £450 million, and it's important. Not just because of the importance of arts, but in terms of the economic contribution of the arts sector in the broadest sense. I think it's in the order of something like 130 billion. And then from a soft power point of view, you know, we're not world leading in many things these days. We happen to be really good in the arts and culture sector. So, you know, I really worry that the government don't fully understand the economic engine that is the arts sector, how important it is, certainly from a sort of educational point of view, young people, mental health. You know, it's much broader than just DCMS. You know, it makes a big contribution to creative skills, how they're applied and transferred across so many other sectors. So, you know, this is a jewel in UK PLC, and I think they need to sort of wake up and understand how important it is.
But what's the right way, again, to fix it? Is it just, you know, government funding? Is it getting closer to Europe to help with visas, also for artists?
I think the visa problem is a huge issue. And yes, government funding, you know, we've just had a tiny increase, which is like just over 1%. It's the first increase we've had for something like 7-8 years. Between government funding and tax relief, it's really helpful. But I think they should really get behind it and see it as an engine of growth which they need to promote further. And, you know, not just we, the Opera House, face big challenges, but across the whole sector. And also there's this tendency to look at sort of one-size-fits-all. Grassroots is important around the country, but, you know, you need to respect and nurture the totemic institutions. It's not, one size does not fit all. The sports world gets this right. Grassroots sports, elite sports activities, they get it right. They need to do that for the arts sector.
Tomorrow is a big day because of this Liberation Day, so-called Liberation Day that Donald Trump has announced because of trade and tariffs. How much will that complicate the UK's life?
Enormously. I mean, I don't get it. You know, since 250 years ago, Adam Smith, you know, wrote his Wealth of Nations and said that free trade was the ultimate way to promote economic growth. You know, I understand Donald Trump is a deal maker. In my experience, the best deals are win-wins. You know, this is going to be a lose-lose. This is going to restrict economic growth. It's going to stoke inflation. It's going to discourage investment. It's going to result in escalating trade wars. And, you know, I understand that I think the OBR are estimating that it could impact our economy by in the order of something like 18 billion. So I don't see it as Liberation Day. I see it more as Protectionism Day.
But so what's the way forward? And again, it's unclear whether President Trump wants a deal, whether it's a way of getting money back in the coffers of Treasury. How does Keir Starmer deal with this?
Well, I think my sense is actually his approach at the moment is actually the right one, not to have a knee-jerk, immediate retaliatory response, to feel the way through it, to see if we can negotiate a trade deal, and but it's buckle up time. It's going to be tough.
But do you think allies cannot rely on the U.S. like they used to? And what does it mean for businesses? Do they need to look further east? Is China a viable alternative?
So I've recently got involved I'm chairing a new independent institute for strategic communications. We're doing work with governments around the world, with NATO. And there are concerns in Europe, obviously, about the Russian threat, in Asia with China, and I think that the importance of understanding and achieving big discourses, changes in mindsets. This is an important thing to be doing. Yeah. And particularly, we're looking to apply that to the commercial world as well.
But I guess the problem if you're a chief executive right now is you see all of this news. Hopefully you're watching Bloomberg and you say, I don't really know what to do with it. Let me spend a little bit less until I figure it out. So is there a worry that the economy just seizes up because of the uncertainty?
Well, absolutely. I mean, I just said just before, at the end of the day, it's going to discourage investment because of the uncertainty. Yeah. I think chief executives, are going to have to have to choose their markets. Yeah. I think, the U.S. needs to be careful, that it doesn't end up destroying its brand. To be the biggest, solid, most dependable country in the world, it's doing a very good job at undermining all that, and restoring that reputation will take a long time. And I think I'd always thought that with power comes responsibility, and with that responsibility, it's an obligation to act with humility and in a humane way, and for the haves to help the have-nots. To use economic and military power in a sort of stick-type way ultimately will be very damaging, I think, to the United States.
Is this, I don't know what it means for the UK, is there an opportunity for the UK to, it can't really fill that void because of the size of the country, but to be a link?
I think, Britain is hugely respected for a number of things. And I'm seeing this actually again in the strategic communication area, where countries are coming to us because we're seen as very good at this. I think, I actually think Trump was correct in calling out the European defence thing. I mean, this was a wake-up call, and I think, Europe had been taking advantage of the situation for some time, so I think that's been a good thing. But I think generally, it's forced Europe to address its defence requirements. It's sort of encouraging cooperation, and perhaps, as we watch the geopolitics, the sort of tectonic plates of which are not just shifting, they're sliding, I think this will create new alliances and new opportunities.
Thank you so much for joining us. What a wonderful conversation with Lloyd Dorfman there, the founder of Travelex. Now, let's also turn to one of our tech scoops this morning. We'll get back to, of course, geopolitics and tariffs, but Bloomberg understands the Commerce Secretary, Howard Lutnick, could withhold subsidies that have already been agreed under the U.S. CHIPS Act. Now, President Trump has called on Congress to repeal the law. Bloomberg's Tom McKenzie is here with the latest. So, Tom, what exactly is the strategy here? Because a lot of people were really taken by surprise.
Yeah, Fran, so you'll remember that the CHIPS Act and Science Act was signed in 2022, and it allocated $52 billion in terms of grants and subsidies to chip companies, semiconductor companies, to boost their investments and build out things like foundries in the US. The Commerce Secretary, Howard Lutnick, looking basically to squeeze more juice from the orange, looking to withhold some of these subsidies to compel those companies, whether it's Intel or Samsung or Micron and others, to ramp up their investments in the US without additional grants. So there's a stick approach, which is withholding some of these subsidies, and also, of course, President Trump's own threat of tariffs on the semiconductor industry. That's the stick. On the carrot front, we are hearing from our reporting that Howard Lutnick, the Commerce Secretary, is also open to considering increasing and pushing out a tax credit of 25% for these companies that actually has proven to be more valuable than to them than the subsidies themselves. So that is the reporting in terms of how they're looking to adjust this. Some of these companies have already, of course, pledged to spend, and a part of this seems to be down to, as well, trying to build a template on what TSMC have done, of course, the owner and operator of the biggest foundries over in Taiwan, who recently committed to an additional $100 billion of investments in plants in Arizona. And that seems to be part of a template that the Commerce Secretary is looking to use as he wants to drive up, of course, the investment numbers and the dollar numbers that he can then hand over to President Trump and they can claim as a win.
So could a more hardline approach, by the U.S. to subsidies actually boost China's standing in the chip race?
Well, as you were just discussing with your previous guest there, Fran, it's a question of certainty or uncertainty and predictability. The CHIPS Act was a bipartisan piece of legislation signed in 2022 with the backing of both Democrats and Republicans, and now you have a new administration trying to rework that piece of policy. So there's the uncertainty that in some quarters will be a reminder of the unpredictability and the risks around investment. You do not have that 10-year horizon, arguably, that you once had with that CHIPS Act. Some of these companies were on the line already to receive subsidies of about $1 billion, including the likes of Intel, Micron and Global Foundries. Some of those companies have not received the funding that they'd had agreements with the previous administration to receive. That funds haven't come through. Other companies are still waiting to have the talks and discussions with the Commerce Secretary. So that uncertainty is a potential risk. These companies, by the way, have already committed to investing about $400 billion in the US market as a result of the CHIPS Act. So there is potentially a question as to whether or not that commitment now starts to be put into question.
Yes, so many questions. Tom, thank you so much for the terrific briefing. Tom McKenzie there with CHIPS. Now, the AI startup Builder.ai has lowered the sales figures it provided to investors and called its auditors to examine the last 2 years of its accounts. Well, the company has cut revenue estimates for the second half of 2024 by about 25%. Multiple former employees who've asked not to be identified have alleged that Builder.ai inflated sale figures. Now, the CEO has said that discounts given to customers may account for the discrepancies. And SoftBank is said to be seeking a loan of as much as $16.5 billion to help fund AI investments in the U.S. The bridge loan under discussion has a tenor of about 12 months and may help SoftBank lead a $40 billion funding round, which OpenAI has just finalized. Well, coming up, UBS CEO Sergio Martin was the highest-earning CEO across continental Europe's biggest banks last year. Details next, and this is Bloomberg.
So many Europeans feel utterly disheartened by the announcement from the United States. Let me be clear, Europe did not start this confrontation. We think it is wrong. But my message to you today is that we have everything we need to protect our people and our prosperity.
European Commission President Ursula von der Leyen there speaking ahead of Trump's reciprocal tariff plan expected to come tomorrow. Now, German inflation slowed more than anticipated in March as European Central Bank ponders whether to lower interest rates again at their next meeting on April 17th. Now, this comes as UK food inflation hit a 9-month high, adding more pressure to the government. Well, we're now joined by Jamie Rush. He's Chief European Economist with Bloomberg's Economics. So, Jamie, a lot in there. There's UK inflation, then, of course, there's what the ECB is doing. Who has it harder?
Well, I mean, I think the Bank of England has the harder choice in the sense that, wage growth's too high. It's very difficult for them to decide whether they should be cutting and indeed when they will be able to cut. I think for the ECB, I mean, if you look at the data, what would we be saying if we didn't have this conflict going on the trade front? We'd be saying, well, interest rates are now pretty low. Yep. Inflation's broadly heading in the right direction, but still a bit too high. Yep. And so now would be like a good time to pause, take stock and think about, what actual further measures need to be taken. Remember, unemployment's still very low as well. So I think we would be saying that now's the time to pause. Trump's probably got different ideas. And when we look around the the possible impact of tariffs, I mean, I think it's pretty clear that the impact on demand in the economy will be very large for the Eurozone.
Yeah, and actually Bloomberg Economics, and I love the work that you and the team do because it kind of breaks it down and it's very, similar. We don't really know what President Trump is announcing tomorrow on, the so-called Liberation Day, but run us through some of the impacts on inflation, on growth, and what that means for ECB scenarios. Yeah,
so I mean, I think, we look at Trump's trade policy through the lens of the different grievances he has with the EU, right? So he thinks that VAT rates, that they're an export subsidy, so he wants to tackle that. He thinks non-tariff barriers are too high, so, the rules and regulations in the EU are too onerous for firms. He doesn't like digital services taxes. He doesn't like low defence spending. I mean, there's no way that the EU is going to be able to address all of these gripes, right? So, I mean, if we add up some of these grievances, we can easily imagine that you could get to a tax rate of around a tariff rate of 50%. I don't think you'll go that far. But I mean, if you're saying 50 is the maximal, 25% suddenly seems reasonable. So I think we could end up there. And what would that do? Well, you're putting it something between 1.5–2% of GDP at risk in the Eurozone. The immediate impact could be inflationary if the EU
That's a nightmare
responds.
for the ECB to figure out.
Exactly right.
Because you have this pole, inflation and GDP pole.
Yeah, but I imagine that the argument that will win the day is that the demand impact will trump the inflation and potential consequences. Because remember, the EU is going to be clever about it. They're not going to pick things that are going to have huge inflationary impacts. They're going to try and minimise the impact on European inflation. So for that reason, I think demand would be the thing they would focus on, and that brings you towards a world where the ECB has to cut in April and probably has to go a bit further than it otherwise would have had to.
Okay, so interesting. Jamie, thank you so much. Jamie Rush there from Bloomberg Economics. Now, Sergio Armati of UBS was the highest earning chief executive across continental Europe's biggest banks last year, while UniCredit's Andrea Orcel got the largest raise. Let's speak to Bloomberg's Steve Ahrens, who's been looking at the numbers. So, Steve, good morning. Who were the biggest or the big European bank winners last year?
Well, I mean, Orcel got the biggest raise, definitely. I think, if I remember correctly, it was 32% up. I mean, much of it in equity, long-term incentive plans, so the value would fluctuate depending on the share price, but still, it's a steep rise. I think the second one was Hector Risi at Santander with, I think, something like 22%, and everyone else was below that. But Armati is still the best paid.
So how will future interest rates actually, cuts affect some of the bank profits, Steve?
It's actually a positive story right now. It's surprisingly, and that's why the bank stocks have rallied so much in the first quarter of this year. Everyone was expecting that bank profitability has peaked because the ECB has started cutting rates, but there's so much going on. Loan demand is increasing, and fee income from asset management, investment banking services, and wealth management is rising pretty rapidly. So it seems like banks will actually be able to defend their level of profitability or even increase a little more, and that, of course, will be good for pay as well.
Yeah, Steve, overall, I mean, you run a team that basically follow this day in, day out, looking at European banks versus Wall Street. I guess they have benefits, but regulation is one of the big question marks going forward. What are some of the lines of questioning that you'll be looking out for these chief executives in the next 6 to 8 months?
You're right. I mean, there's right now actually a big discussion in Europe, I mean, across the globe, triggered by sort of deregulation push in the U.S. that has now been affecting the European discussion. And there's a lot of deregulation going on in the European Union as well. There's new sort of debates on what to cut, and sustainability regulation will be one area where we'll see relaxation. And there's also a question about actually executive pay. In the EU, there's a cap of bonuses for top management of twice their fixed pay. The UK recently, because it have left the EU, has scrapped that bonus cap, and UK banks have been benefiting from that. And so there's a discussion in EU, or at least EU banks pushing for something similar in Europe.
Yeah, Steve, I mean, when it comes to banker pays, again, will this get a lot of splash? Is there going to get a lot of public outcry like we've seen in the past? Or have things changed on that front?
there's always outcry in the European Union over high and what some people say excessive bankers' pay. There was a sort of a renewed discussion around Marta's pay when it came out. Orcel's pay has been in the limelight, and UniCredit has been making a strong effort to defend the pay, pointing to company performance and benchmark comparisons. There's always discussion. It's at the same level as always, and I think the banks will be able to sort of just sit it out.
Steve, thanks so much. As always, Bloomberg's Stephen Aarons there, of course, who oversees all of our European banking coverage. Now, this is a picture for U.S. stocks. Futures actually retreating. Gold extending some of the winning streak as the arrival of U.S. tariffs is looming over the markets. Now, investors continuing to snap up haven assets, sending gold to a new record high, knocking the 10-year Treasury yield lower. Now, the president's upcoming announcement on tariffs have definitely created uncertainty, leading some investors to be cautious, but also strategists to lower their estimates. If you look at some of the things that we're watching out for, look, I thought it was very telling that Goldman Sachs strategists cut their forecast for Europe's stock 600, following a pretty similar move from the U.S. team. The team led by Sharon Bell trimmed the 12-month target on the index to 570 points from 580, again, citing weaker growth forecasts. Now, the former U.S. Trade Representative, Catherine Tai, is on balance of power later. Catch that conversation at 10 p.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.